Welcome back to the deep dive. It is January 20th, 2026. Today, we are looking at a market that, it just feels like a complete paradox.
It really does.
If you look at the headlines, you'd think the Chinese economy is just stuck. You see property crisis, slow growth, all this doom and gloom. But, and this is a big but, we have a stack of research here that says the smart money is seeing something completely different.
That's right. It's a classic case of the macro headlines hiding what's actually happening on the micro level.
And we are digging into the big takeaways from the UBS Greater China Conference. And just to be clear, this isn't some analyst guessing from a desk in New York.
No, not at all.
This is feedback from over 35 consumer companies, expert panels, and, actual on-the-ground tours in Shanghai and Hangzhou.
It's the real deal. This is a view from the street.
So our mission today is to figure out if the Chinese consumer is actually back or if this is just some kind of blip. Because the data suggests we're seeing these green shoots in places you really wouldn't expect. But before we get to the snacks and the beer, which we will, we have to talk about the setup. The research mentions that the sector valuation is sitting about one standard deviation below the 10-year average.
Which is just institutional speak for it is historically cheap.
So the bar is low?
The bar is on the floor. The market has basically priced in a disaster scenario. So what that means for you as an investor or just an observer is that any positive surprise, any little sign of life could trigger a huge re-rating.
You don't need a boom.
You just need not a disaster.
Okay, let's play devil's advocate for a second. You can't talk about China without talking about property. It's been the engine of wealth there for, 20 years? Is that drag just gone?
No, it's definitely not gone. We have to be realistic. The research is very clear that the property downturn is still a factor. For the average Chinese household, where your apartment is basically your primary savings account, that hurts.
Of course. It makes people feel poorer.
And when you feel poor, you don't go out and buy a new sofa.
Exactly. So where is this confidence coming from then? If my house is worth less, why would I suddenly start spending in 2026?
That's the big pivot we're seeing this year. It's the wealth effect shift. So, in 2024 and 2025, property was the whole story. But now analysts are pointing out that the stock market has started to perform better. And as equities improve, it sort of acts as a counterbalance to the property slump.
So your apartment might be down, but your investment portfolio is finally showing some green.
That's it. And psychologically, that can be enough to unlock the wallet. But, and this is the absolute key to this entire deep dive, they are not unlocking their wallets to buy the same things they used to.
Right. The days of just, mindless buy it because it's expensive consumption are over.
Completely over. The theme for 2026 is divergence. It's not that spending has stopped. It's that it has become hyper-rational. The buzzword across every single sector we looked at is value for money.
Value for money. It sounds great, but it's almost a cliche, right? Everyone wants value. What does that actually look like on the street in Shanghai right now?
It looks like the snack discounter.
Okay, this section of the research just blew my mind. I think most people are completely missing this. We are talking about an explosion of stores.
It's a retail revolution. Just look at the numbers. In 2025, there were roughly 56,000 of these stores.
Which is already a huge number.
It is. And the projections from these expert meetings suggest that number is going to hit 70,000, maybe even 80,000 within just 3 years.
That's nearly a 50% increase. For a listener who hasn't been to China recently, paint a picture. Is this like a dollar store? A chaotic bargain bin?
No, and that's the key misconception. These are highly efficient, really curated stores. They're smaller than a supermarket located right in your neighborhood, and they sell brand-name snacks at a huge discount, sometimes 20 to 30% cheaper.
So it's clean, it's branded, but it's cheap.
Precisely. And the industry is consolidating fast. You have these big players like Wanchin and Busy Ming just swallowing up the market. They're becoming the gatekeepers.
Okay, but here's what confused me. You have these massive legacy brands like Want rice crackers. Historically, big brands hate discounters. They think it cheapens their image. But the report says they're leaning in.
They aren't just leaning in, they are becoming dependent on it. Look at the data.
Yeah.
Want sales inside these snack discounters grew by over 50% year over year. It's now almost 10% of their total sales.
So they just realized they can't fight the tide.
They realized the customer migrated. If your customer is at the discounter, you have to be there too. If you're not on the shelf at Busy Ming, you just aren't getting bought.
And I saw Weilong mention the spicy konjac snack leader. They seem even more aggressive.
They are all in. Weilong is targeting this channel to be 30 to 35% of their entire sales mix by 2026.
That is a third of their business. That's not a channel strategy. That's a lifeline.
It's a fundamental shift. And the reason it works without killing their margins is efficiency. These discounters don't ask for sliding fees or fancy marketing support.
Yeah.
They just want the product cheap and fast. It removes all the friction.
So the consumer gets a deal, the brand gets volume, the store gets turnover. It's a structural change.
It's the Amazon effect, but for physical retail, stripping out all the fluff to get to the price.
Speaking of stripping out the fluff, let's talk about the freshly made beverage sector. Bubble tea, fruit tea.
The gumming case study.
This was my favorite part of the research because it involves sweet potatoes. Which sounds kind of ridiculous, but bear with us.
It does, but it explains everything. First, just look at the scale. Gumming is an absolute beast. They netted over 3,000 new stores in 2025 alone.
That's nearly 10 stores a day. That is blistering speed.
It is, but the strategy has shifted. During the pandemic, the model was all about delivery. Subsidies, getting a guy on a scooter to bring you your tea.
Which was convenient, but expensive for them.
Way too expensive. Those subsidies are gone. So gumming is pivoting back to dine-in. They want you in the store. They're adding coffee, breakfast, desserts, turning the tea shop into more of a hub.
But to get you in that door, they have to keep prices low, that value for money thing again.
Exactly. And this is where the sweet potato comes in.
Okay, let's hear it.
So they have a popular cassava dessert. Instead of buying ingredients from a wholesaler, gumming goes straight to the source. They go to Guangxi, they source the sweet potatoes directly from the farmers, and they process them in their own facilities.
So it's vertical integration, like Henry Ford owning the rubber plantation for the tires on his cars.
That's it, exactly.
Yeah.
By owning the dirt, effectively they control the cost. They have a 100-person R&D team, just for tea, that designs the menu around ingredients they know they can source cheaply at scale.
That is the aha moment here. To win in this market, you have to be an operations company first, not just a marketing company.
Spot on. You can't fake the efficiency needed to deliver the value.
Let's pivot from tea to alcohol. The report highlights this fascinating split between Baijiu, the famous Chinese spirit, and beer. They're going in opposite directions.
Yeah, this is a great example of how cultural shifts impact markets. So with Baijiu, historically, it was the drink of face. Business banquets, government dinners,
prestige consumption,
at least.
signaling status.
Right, that's fading. The shift is toward private consumption, drinking with friends and family. Because of that, the price point is dropping. The sweet spot is now the mid-end, around 300 to 400 renminbi.
So the $50 bottle, not the $500 bottle.
Exactly. It's accessible quality. And companies like Sweltham, they saw this coming. They've managed their inventory down to just 2 months.
And low inventory is good because...
It means they aren't stuffing the channel. The product is actually moving off the shelves. They're lean.
Okay, so Baijiu is moving to the rational middle. But beer looks different. Beer is getting fancy.
Beer is telling a story of premiumization. Now, there's 2 terms we need here, on-trade and off-trade.
On-trade is bars and restaurants, off-trade is supermarkets, drinking out versus drinking in.
Correct. The on-trade drinking out is struggling, but the off-trade drinking at home is booming. And crucially, when people drink at home, they're buying better beer.
The little treat logic, right. If I'm not spending $100 at a bar, I can spend an extra $5 on a nice 6-pack for the fridge.
Exactly that. Look at CR Beer. The overall beer market is soft, but their Heineken volumes, their premium brand, are expected to grow at 20% year over year. That's a huge signal. People are drinking less, but drinking better.
So we have smarter snacking, integrated tea, mid-tier spirits, premium home beer. Let's zoom out. Literally, let's look outside of China. Because for the big appliance makers, the story seems to be get out.
Go global is the mandate. The domestic market for appliances in China is just saturated. I mean, think about it. Everyone who needs a washing machine pretty much has one. Growth at home is flat. So giants like Midea, Haier, and Hisense are looking overseas.
But isn't that getting harder? You hear about tariffs, trade wars, rising shipping costs.
It is harder. But these companies have evolved. They aren't just dumping cheap toasters on the world anymore. They're building real brands. The report notes that despite rising material costs, these companies are actually hiking prices overseas.
Wait, they're raising prices?
They are, and that's a sign of power. They're competing on quality and brand, not just being the cheapest.
And they seem incredibly confident. I saw Haier is raising their dividend payout ratio. For our listener, why does that matter here?
It's a signal of confidence and safety. A company doesn't hand out more cash to shareholders if they're worried about next year. It tells investors, we are stable, we're generating cash from these overseas sales, and we are safe.
Now, there was one acronym in that section that stopped me. IDCHVAC. It sounds like the most boring thing in the world, but you think it's a secret weapon.
It definitely wins the award for driest acronym. It stands for Internet Data Center, Heating, Ventilation, and Air Cooling.
Ah, it's the shovel in the AI gold rush.
That's it exactly. Think of all those massive AI models. They generate an incredible amount of heat. If you don't cool them, they melt. So Medea, Hair, Hisense, they are all pivoting to build these massive industrial cooling systems.
That's smart. If consumers stop buying home ACs because the housing market is slow, you sell industrial ACs to the tech giants who can't build them fast enough.
It's a completely new growth engine that has nothing to do with the consumer economy and everything to do with the global tech boom. A perfect diversification?
I want to hit the niche categories before we wrap up, because we're seeing resilience in some very specific areas, sports and pets.
These are what we call passion points.
Yeah.
Even when people cut back, they protect the things that define their identity. So take sportswear. The mass market is tough.
Yeah.
But niche categories like outdoor sports, hiking, specialized running gear, they're still projected for positive growth.
So I won't buy a new pair of shoes for the office, but I will buy new trail runners because that's my hobby.
Exactly. The specialist market is alive and well. And then you have pets.
Pet parents feel like they're recession-proof.
They practically are. The data shows the industry is 85% online, and the trend is distinctly trading up. Domestic brands are seeing growth in their mid to high-end food.
So people are eating cheaper snacks from the discounter, but the dog gets the premium kibble.
That is literally what the data suggests. It's the humanization of pets.
Yeah.
People will sacrifice their own dining experience before they downgrade their pet's nutrition.
And speaking of spending, Laopu Gold. This blew my mind. Triple-digit growth.
In a shaky economy, yes. Laopu Gold focuses on heritage craftsmanship. They target VICs, very important customers.
The ultra-wealthy.
Right. It just proves that the very top end of the market operates in a different reality. If you offer something truly unique, the money is there.
So it seems like the middle is where the pain is. The bottom snack discounter is booming. The top Laopu Gold is booming. The middle is getting squeezed.
That's the classic K-shaped recovery. And you see that battle for the middle-end restaurants. You have chains like Shaokaiyuan slashing prices, and then Baijiu upgrading decor to justify their prices. It's a knife fight for that middle-class wallet.
And then there's Sunart Retail, the hypermarket chain.
Yes, and they're restructuring heavily. But the signal is their dividend yield, implied around 10%. That's a company basically saying, look, growth is tough, but we are generating cash, and we will pay you to stick with us.
Okay, so bringing this all back, we started with green shoots. If you had to summarize the mental model for our listener, what is it?
The mental model is calculated recovery. The easy growth era is dead. You can't just open a store and expect to get rich. The winners in 2026 are the efficiency masters.
The operator.
The operators. The snack discounters who optimize the supply chain. Gumming, who bought the sweet potato farms. If you're not efficient, you die. If you are, you can win big because the competition is falling away.
It's a market for professionals, not speculators.
Exactly. And that raises the big question for the future. We said the stock market might make people feel wealthier. If that happens, do they go back to their old habits?
That's the question. If I feel rich again, do I stop going to the snack discounter and go back to the premium supermarket?
Or has the discounter permanently changed your expectation of value? My gut says the latter. Once you realize you can get 90% of the quality for 50% of the price, you rarely go back to overpaying just for the sake of it.
The efficiency gains might be the permanent legacy of this downturn.
I think that's a pretty safe bet. The Chinese consumer has leveled up their savvy, and retailers have to match it.
We're going to leave it there. A fascinating look at a changing China. It's not just about spending more or less. It's about spending smarter. A huge thank you for breaking all this down.
My pleasure.
And to you listening, keep an eye on your own value for money choices this week. You might be part of the trend without even knowing it. We'll see you on the next Deep Dive.